Folks, Guy Adami here with my good friend Dan Nathan. Hopefully you know us from CNBC's Fast Money. We're here with something we're going to call the macro setup, brought to you by our presenting sponsor, Nadex, the premier U.S. exchange for trading binary options, knockouts, and call spreads. We're thrilled to be here. Dan Nathan, how are you?
Doing great, Guy. Great to be talking the macro with you. You know, you and I spend a lot of time talking about individual stocks, catalysts for them, earnings, trade setups, that sort of thing. This is going to be a really great opportunity for us to talk about the indices, whether it be equity indices, whether it be other financial risk assets like currencies, commodities, volatility products, that sort of thing. And we kind of nailed the timing of this. It's a pretty good time to talk about volatility and to talk about things moving around a bit. What do you think's driving the market action here? We're Wednesday. It's about lunchtime on the East Coast here. We got a big up day in the S&P 500. Yesterday we had a big down day. Friday we were down. What's going on here?
Yeah, what a difference a day makes. And, there's so many catalysts over the next month and a half as we get into election season, and we've written down a bunch of them, and I want to speak to them. But to me, Dan, the one that is on top of mind after obviously the Federal Reserve is stimulus. And if you watch Fast Money on Tuesday night, and obviously today's Wednesday, Dan and I had an interesting conversation at the top of the show about what we both thought was going on. Obviously, yesterday, the market took a severe turn to the downside after President Trump tweeted basically saying, you know what, game's over in terms of stimulus. I want all the people in the Senate to focus on the Supreme Court nomination, ratchet that through. We'll pick up stimulus when I win in January. So the market didn't like that. And now the conversation Dan and I had was, Dan took one position. My position was, and I'm going to stand by this, you can say it's right or wrong. I'm not debating whether it's right or wrong. But my point is President Trump is laser focused on the stock market. And he saw what happened, and he was going to do some about face and claim victory and say, see, the obstructionist Democrats, look what they're doing. I can ratchet this through. And to a certain extent, I'm not taking some victory lap here, but I think you see what's going on because he clearly didn't about face last night. So he understands what's going on. I think the market does. Dan, what do you think?
So I don't think he understands what's going on. I think to your point, he is too laser focused on the stock market. He doesn't get the difference between the economy and the stock market. There was a tweet, I think, in that tweet storm yesterday, jobs, jobs, jobs. Well, if I go back and look at jobless claims for last week, they were disappointing. If I go look at the September non-farm payrolls, on Friday, they were disappointing. If I go think about what Fed Chair Powell said yesterday, that the unemployment rate isn't 8%, it's probably like 11% because so many people have left the workforce. And I think the most important thing is that Powell has said this now, and right or wrong, they hit this economic and health crisis hard, the Fed did, right? Back in February and March. And they've been begging Congress, the White House, and the Treasury to keep up with the fiscal stimulus. They recognize the issues, the scars that are going to be left on our economy for years to come here. And so the fact that we have this back and forth between will we get further stimulus or won't we, the economy is listing a little bit. We had this nice V reversal off of the lows when we lost literally more than 20 million jobs in March, right? But we still have, close to 20 million people unemployed right now. And there's a lot of people where we're 2 months past this expanded unemployment benefits that ran out. People need money to keep this consumer-led economy going. They need money. So to me, I just don't, I don't get it, what the president's trying to do. I think he's too focused on the stock market and he's not seeing the forest for the trees.
Yeah, I don't disagree with that. But, I'm just trying to discern what's going on. And when he was elected president, he said it, members of his administration said it, that the stock market will be a report card for our administration. So I have those words echoing my head. So every time I see a move like yesterday, it dawns on me that they're going to do some counterbalancing act to get it back on track. Again, whether that's right or wrong doesn't matter. And quickly, we're a country of 350 million or so people. I think as of last that I looked, there were 30 million odd people getting aid in some way, shape, or form. I mean, that is catastrophic to your point, and that's obviously top of mind. But I think we should take a look at, Dan, the broader market, because obviously the S&P 500 is what everything sort of drills down from. And we have a chart, and you'll notice, 3360.95 at the top. That's that whoosh to the downside that we saw yesterday. And we just wanted to show you that because how quickly things have changed, because as we're speaking now, that's gotten it all back and then some. And it's fascinating to me how quickly this market turns on a dime. I have some levels I want to talk about, Dan. I want to keep this chart up. I hope you have some things you want to talk about. If you look, the March low, I think we all sort of know what happened there, so it's not worth talking about. But what I will say is this: the recent low that we saw in the S&P 500, and we have that green line drawn, was 3210. The high obviously came in the form of 3588 a month or so ago. The 50% retracement of that move is exactly where we find ourselves now, basically either side of 3400. And guess what? That also, Dan, was the prior high we saw back in February. So this 3,400 level, in my opinion, makes sense for a number of different reasons. Now, here's where you put your trader's cap on, in my opinion. If you're in the bull camp, what are you looking for? Well, in my opinion, you're looking for 34.94 to the upside. And what is that? That's a 50% retracement of that recent all-time high and this 3,400 level that we just talked about. If you're in the bear camp and you want to play it there, what are you looking for on the downside? And I would submit it's 33.05. What's that? That's the 32.10 recent low, this 3,400 level, and that's the 50% retracement. So you can almost visualize it if you look at the screen here. So those are the levels in the S&P 500 that I'm looking at, and I think it all pivots on this 3,400 level that we're vacillating around, Dan.
Yeah, key level, no doubt about it. I would just say this, that if you are in the bull camp, there's two catalysts, right? If you get a stimulus bill passed, even something that looks skinny, you're going to get a rally off of that. And then any accelerated commentary or data about therapies or vaccines, that sort of thing, from reliable sources here, you're going to have a move back up to that 3,500 level pretty quickly. I think if we have a deal, on the stimulus where $1,200 checks go out, I think that's the sort of thing where you have a little bit of a short squeeze, but it gets sold. It's just such a near-term stopgap, and it's going to take a while for that money to get out. I think it's important to also recognize that 3,200 level where we bounced a few weeks ago would be kind of key near-term support. And then, 3,100-ish, which is the 200-day moving average, looks like pretty good support here. Listen, I just think that the likelihood of a huge rally in front of the election back to the prior highs isn't great. I could see a number of scenarios if we do not have a contested election and there's a clear winner, and then the Senate does a certain thing or not. I think that you probably have a move back up towards those highs. Think about it this way. Every day that goes by, we get closer to a vaccine at some point in 2021. The stock market will discount that before it happens. And it may be doing that to some extent right now. All right, so there's the S&P 500. Obviously, mega cap here. I think it's really important. There's a headline overnight about just some of the antitrust commentary about mega cap tech. I think this is really important for this conversation that we're having here. If we look at the NASDAQ 100, the NDX, the QQQ is the ETF that tracks it. We know 5 stocks. I call them FMAGA: Facebook, Microsoft, Apple, Google, Amazon. Okay. They make up 45%. Throw Tesla in there. They make up 50% or so of that index of 100 stocks. I think that's a really interesting setup here, because they're really driving the performance of this index. And what are we seeing today? We're seeing some slight underperformance. Google is down, Facebook is down, Microsoft's up less than the S&P 500, so is Apple. And those are important to me because are regulatory issues that seem to be bipartisan, whether, this came from a Democratic Congress, right? This report, no matter what happens, they are coming from a regulatory standpoint for these major companies in tech that or make up, 23% of the S&P 500 and 45%, again, like I was saying, the mega cap ones. What does it mean for the NDX here? Because this is also contending with an interesting technical level. I think that uptrend from the March lows will serve as massive technical resistance resistance above 12,000. And then we have this level in and around 11,000 just below here that looks like kind of interesting support. But have to go all the way down to about 10,000 where the 200-day moving average is. What do you think the drivers right now of these mega cap tech stocks, and particularly the NDX, the NASDAQ 100?
I think for me, the drivers are two things. Headline risk, which you just discussed now in terms of the headlines that came out last night and anything that's going to happen in terms of regulation and potentially breaking these companies up, number one. And number two, are we going to see some rotation out of growth and into value? And what does that look like in terms of these stocks? And to a certain extent, you might have seen it over the last couple of weeks. In terms of levels, and this is a great chart, Dan, you have this significant uptrend from the March lows, recently broken. You obviously had that big downdraft, and now we're starting to see a recovery, albeit, sort of a grinding higher one. What I think is going to happen is you're going to get some sort of headline relief for these stocks. You're going to see it back test that uptrend line, which probably comes in the form of a little north of 12,000. With each passing day, obviously the level gets a little higher. But I don't think, Dan, we're going to take out that 12,440 level, the all-time high that we saw recently. So if you're asking me to gauge just how I see it playing out, that's how I see it playing out. I think we're going to see a spike up to the uptrend line, a failure there, and then probably a test potentially of that 200-day moving average, which will probably come in either side of 10,000. That's how I see it playing out.
Yeah, it's funny, when I think of those major names, obviously you just said growth. Some of them are trading at very high multiples relative to that growth or relative to their earnings, while others, Google and even Facebook, are trading very cheap to their recent history. So that'll be a really interesting thing as we get into the new year, as we think about what the major headwinds are for regulatory scrutiny, what the costs associated with that. I think that's really also interesting to think about is that what does decelerating growth, a lot of these major tech companies that we just mentioned, really, I hate to use the expression, won the pandemic. They were built for this sort of environment, especially while a lot of bricks and mortar competitors, whether it be from an e-commerce standpoint or a whole host of other ways, were basically put out of business for months and months, and these guys did very well. What does decelerating growth in 2021 look for some of these, some of these major companies that have gained trillions of dollars in market cap as a group over the last 6 months or so?
Well, what's interesting is you're seeing decelerating growth.
Yeah.
I mean, there's still astronomical growth rates for some of these companies because these are very mature companies, but growth is decelerating in some of the drivers for the companies. I mean, you can talk about Amazon if you want to get granular. There's still the growth there in AWS, but it is decelerating, right? So you're seeing that now. The problem is, or the fact of the matter is, the market doesn't seem to care. And I say this all the time, this is not meant to be glib. The market doesn't care until it does. And I do think at a certain point it will, and it probably comes at the turn of next year. So that's not, I'm not trying to not answer your question, but we've seen this time and time again. Things work until they don't. And when they don't, it becomes very, very, very negative very quickly.
Yeah. So here's something that seems to care, and I know it's a index that you kind of are pretty focused on. It's the VIX, the S&P Volatility Index, and so this one is interesting when we talk about seems to care. The fact that we have the S&P 500 within 5% of its all-time highs made on September 2nd, and we have a VIX that's still pretty well elevated. It's been trading in the mid to high 20s for the last few weeks, despite the fact that the downward volatility has at least settled down. What is that saying to you a little bit? Is it saying that, portfolio managers or individual investors are still particularly worried about a big sell-off, and therefore they are looking and reaching for protection in some of these names? And again, some of these names have had fabulous performance in a period of time over the last 9 months where you would have expected really subpar performance when you consider the damage to economic growth, the damage to consumers, the damage to, the employment situation. What's your take about a VIX? Even today, I'm looking at the S&P up 1.3%, and I see the VIX only down, 3.5%, trading at 28.5 or so.
And if you ask me to sort of game out the rest of the day, I happen to think the VIX is probably going to go positive today and close somewhere between 29.5 and 30 or thereabouts. So, but that, Dan, is probably neither here nor there. I think if you ask 10 different market participants, you can get 10 different answers in terms of what he or she looks to the VIX for. I look at it as sort of a barometer of things. Where is the world? For example, when we made that prior all-time high in the S&P 500 that we talked about, that 3393 level to be exact, back in February, you were talking about a VIX that had a 14 handle. Today, with the market at the exact same level in terms of the S&P, you have a VIX that's twice that. What is that telling you? I think it's somewhat foreboding, and I think it speaks to some of the concern out there in the broader market, and I don't think it's particularly bullish. And quickly, because I know we're sort of on a clock here, Dan, one of the things I've said on our show, Fast Money, a number of times, you're probably going to see a short-term bottom when you see the market selling off as the VIX sells off. And quite frankly, that's exactly what we saw a couple of weeks ago when we had a 35 VIX in a market that was selling off, and the VIX went from 35 to 28 pretty much in a straight line, and that sort of put in that 32.10 or so low that we talked about. Now what are you seeing? You're seeing a rallying market with basically a rallying VIX. That tells me we're probably within a week or so of the market putting in a short-term top. That's how I view the VIX. I do think we're probably going to see a 35 handle in the VIX at some point, and that probably coincides with the market trending to the downside of the levels we talked about earlier.
Yeah, and I think that it's important to remember that this is probably one of the most unusual months if you get from a market cycle standpoint. We have an election in less than 30 days. We have Q3 earnings season that is starting next week in earnest. And when you think about, the S&P 500 up 5% on the year, the NASDAQ up 25%, you think about how concentrated that performance is in a small group of names that, those 5 names make up $7 trillion in market cap. So, the idea that you're seeing some portfolio hedging into this election, I think is kind of important. Let's talk before we get to some stuff away from equity land. Let's talk about Q3 earnings season, because I think that, we know, when you think about kind of identifying catalysts for the market, once a quarter, 4 times a year, take it to the bank. We know that companies are going to report earnings. We know that we see big moves. A lot of times you'll see stocks moving as a group, depending upon what the sentiment was on the broad market and what the results that we got and what the outlooks look like. One of the things that obviously markets hate is uncertainty. And, basically in Q2, we didn't see a lot of forward guidance from companies. They didn't have very good visibility, right, of what their next quarter was going to look like. I suspect we start to see a little bit more of that. What do you think in general, earnings season is going to do for this market right here? Let's say, take the election aside. You know what I mean? What do you think it does from a sentiment standpoint? And are there any groups that you're really keying on that you think could really drive the S&P 500 out of earnings season?
A lot of questions there. I'll answer the last question first. The groups that I'm focused on are the ones that are going to start next week, and that comes in the form of the banks. And we don't need to get granular in terms of what banks are interesting here, but I do think bank earnings are going to be fascinating. And they're going to be fascinating to me. Do these banks say, you know what, we took these huge loan loss provisions, we're starting to see light at the end of the tunnel, we're going to ratchet back, which I think would be very bullish, or we still have no clarity, loan loss provisions still have to be escalated? That would be concerning, and I think that's what you need to look for there. And if you're looking for specific metrics in terms of these banks, to me, look at their tangible book and then do the math on the back of that, and we can talk about what the math is at a later date. The other space, obviously, to me, are industrials, and Caterpillar is the one name that I look to in terms of clarity. What are they seeing? Does that speak to some global reacceleration, or things still stuck in the mud? But earnings season to me is going to be disappointing because I don't think we can get anywhere near the earnings we need to make the valuations of the broader market reasonable. Now, the other side of that coin is people say valuations don't matter in an environment where you have central bank intervention to the scale that we've seen. I happen to think that valuations always matter, and that's what I'll be looking for, obviously, over the next couple of weeks.
Yeah, I think the sentiment towards banks and what they have to say is really important. If the news isn't as bad as expected and the stocks act okay, I think that's probably pretty good for the broad market. You also used the term before, rotation, especially as it related to the mega cap tech stocks. You might see a situation where people move out of some of these major tech names and rotate more into financials, which have massively underperformed underperformed. Maybe energy would be a big proxy for a reflation trade from global growth, and obviously the industrials. I worry when you talk about CAT and some of these industrial companies, they've had massive runs. I think they're anticipating, what I mean, some better than expected news, from in that regard. So rotation will be definitely important. Let's talk about an input, though. I think that we're going to hear a lot about in earnings from CEOs and CFOs, that sort of thing. And that's the weakness in the U.S. dollar.
Yep.
As the dollar was rallying earlier in the year and last year, we heard a lot about just the kind of the headwind for a lot of our multinational companies that rely on growth overseas as a good part of their growth. Look at that chart right there. That's the Dixie, the U.S. dollar index. You use whatever cross that floats your boat. I'll let you speak to the crosses. But, when we had that period of uncertainty in February and March, I mean, the dollar was manic, right? And it made that multi-year high. And then look at it's just been in this crazy downtrend. We just had a little bounce in the last few weeks, and it got right back up to that breakdown level from July, and then the downtrend from March. What's your take on the dollar here? And do you want to extrapolate it a little bit, what the weak dollar might mean for U.S. multinationals as we come out of Q3 earnings season?
Dollar is critical to me. The dollar is textbook in terms of what it's done. I mean, you look at that high we made, I think back in March, and then you see the subsequent move. To me, it's textbook. And by the way, in a lot of ways, it sets up the same way the NASDAQ is going to set up, except the exact opposite. I think here we are, we're going to retest this downtrend line, which we're basically in the midst of right now. You had this big bounce off the low. I happen to think with everything going on, it's extraordinarily bearish for the U.S. dollar, because I do think you're going to see some form of fiscal stimulus in the new year. And how do you pay for it? Well, you create money out of thin air. What does that do to the dollar? It knocks it down. So I know a lot of folks out there, Nadex, are loving trading the Aussie dollar, US Aussie, sterling, dollar yen. You have to trade those three things or five things. You need to have a view in the US dollar. And my opinion is the dollar's headed for the next leg lower, and it's going to be a significant drop as we get later into this year and earlier next year. And I understand in terms of the stock market why people will say a falling dollar creates tailwinds for multinationals. I totally get it. Mm-hmm. I also think there's a point of diminishing marginal returns in terms of that. And I think we're precariously close to it, because guess what, folks? This is a 73% economy that's driven by the consumer, and a weakening dollar is a tax, and it's very inflationary, and it hurts your buying power. And I think we're all going to start to feel it. So my view of the dollar is we've had this retest of that downtrend line, and we're headed for the next leg lower.
Yeah, but brother, that's not news to anybody. I mean, when you think about it, when QE started, back during the global financial crisis, and we went to zero interest rates, what was the Fed trying to do? They were trying to inflate the economy back up and deflate the dollar. So politicians will tell you they believe in the strong dollar, and the Fed may say the same, but their actions over the last 12 or 13 years kind of speak otherwise. Mm-hmm. And what are they really most focused on right now? What is Fed Chair Powell said over the last, 5 or 6 weeks, is that they are going to keep interest rates low for a long time in an anticipation of creating some inflation. All right, now I'm going to set you up, my big man here.
I like when you do this.
What is your best play for a weakening dollar in this sort of environment that we talked about? And I know this is going to go back to your roots here a little bit.
You know exactly what it is, and we have a chart to speak to that. It's gold. And I think we probably have an XAU chart.
Yeah.
But it's gold, and you can speak to this. I know you and Carter Braxton Worth are the technicians, and you talk about pennants and all these different things, and flags and bull flags. But I happen to think we're in the midst of one right now. And you put up a great chart there. Obviously, gold's had a significant pullback since the middle of the summer, probably in correlation with that bounce we've seen in the U.S. dollar. But I think, again, if I think the next leg lower for the dollar is in fact lower, I think the next leg for gold is higher. And I think we're going to break out of this pennant that we've been forming for a while. If you go back just a couple, well, actually, it's probably longer than that now, but Warren Buffett, who historically has found gold to be abhorrent, bought a gold mining stock. That speaks volumes. By the way, that was in the wake of him getting out of a lot of his bank stocks. So you can't kneel at the altar of Warren Buffett when it suits you and then discount him when it doesn't make sense. I think he clearly sees something. I think gold is going higher, and I think you play it with a breakout here at these levels that we flagged on this chart. And if you want to get granular in stocks, there are obviously ways to play it there as well. But to me, gold is about to move to the upside, and it's probably going to do it in correlation with the dollar moving lower, Dan.
Yeah, I would just say that chart looks like a really interesting setup. Obviously, the downtrend from the early August lows, is pretty well defined, and it's got a little support at that uptrend. I don't think you want to be long gold breaking that uptrend. So for traders out there who are kind of playing for the breakout, I think on the downside, the stop to me is that uptrend. I'll also tell you that I found it kind of concerning that when the stock market, was declining in September, gold wasn't particularly acting that well. And so to me, this is one that I think, listen, you have the trade here, you have that downtrend, you have that uptrend, you have some stops to put in there. And that makes some sense to me. I think I like the idea of playing for a move. I think you're playing for 2000 near term. Is that the move in the
Absolutely.
XAU?
I happen to listen. I think we're taking out the highs we saw in July.
Okay.
I mean, that's just my opinion. Listen, everything that's going on in the world right now leads us to the gold market. And I'm not some tinfoil wearing gold conspiracy theorist, but I did trade it for a long time. And I understand gold is not a story until it's a story. It was a story this summer. It's going to be a story, I think, as we get late into the fall and early next year.
All right, so let's wrap this up. We have a few minutes left here, and I think there's a couple interesting things because there's clearly some identifiable catalysts. I think yesterday's price action in the market, with that tweet from the president, obviously was a tape bomb. It was something that we did not expect. But there's a couple other events, as it relates to politics, which will dictate fiscal stimulus and the course of action by our elected officials going forward. Obviously, tonight there's a VP debate. I don't think anyone thinks that's going to be particularly impactful. And then depending upon President Trump's health, there's supposed to be one October 15th between he and Biden. And what's important to me is when we got to think about the polls, we think about the betting odds, and we think about, okay, right now, if the election was held tomorrow, it looks like there's a very high probability that Biden would win and the Senate would flip to the Democrats. And what does that mean? And this is really important. That would mean that they're just going to spend, right? Infrastructure, everything it takes, right? And so I think that's something that risk assets would like, if you think about it. I think it's something that the Fed would like. But I also think there's a couple other ways to think about it. There's also going to be that corporate tax rate's going to go up. And that might be one of the reasons we haven't mentioned that, right? So when we think about where it went under the Trump tax cuts a couple of years ago, that could be another reason why some of the major US companies and the primary beneficiaries were that FMAGA, the Microsoft, the Apple, the Google, the Amazon, those sorts of names. So what do you think about the political landscape here over the next week and a half or so? And what do you think the bias will be for the S&P, given what we know is going to go on over the next month or next week or so?
I think to me, it's clear that the market is becoming more comfortable with the potential of a Biden-Harris victory.
Yeah.
I mean, I think that's just pretty clear in terms of the price action. I think there'll be people that will try to do things to sort of rage against that and say, if you vote these folks in, your beautiful 401ks are going to be a disaster. And, who knows what's going to happen. The knee jerk on a victory, on a Democratic victory might be to the downside, but I think the market will get comfortable with it. But everything you just talked about, the spending, all might be great for risk assets. I understand that. I think it's going to be really precarious for the US dollar. I think it's going to be fascinating to see what happens in bond rates, which we'll talk about next week.
Yep.
And I also think it's going to be really bullish for gold. So that's my sort of take. Oh, and by the way, this VIX at 29 or so is not going away anytime soon, which should be interesting for traders, but worrisome for investors, in my opinion, Dan.
All right. Well, that was the macro setup brought to you by our presenting sponsor, Nadex, which is the premier exchange in binary options, knockouts, and call spreads. Guy, this was a lot of fun. We got to talk about the major indices, not get too granular in the weeds on the individual names that make up at least the equity indices. We got to talk about the things that used to trade back in the 50s. What is that, gold? When you started your career. But it was great to be with you.
It was fun. And folks, we want to get your feedback. So you can reach out to Dan at Risk Reversal on Twitter, Nadex at Nadex. at Guy Adami for me if you want to reach out. We're looking for input. Tell us what you like, what you don't like, what we'd like to see. We're going to be back with you next week. Thank you, Nadex. Dan, thank you, and we'll talk to you all soon.
See you next week.